Most Americans believe the financial system exists to reward hard work. That if you save responsibly, invest wisely, and play by the rules, the system will eventually work in your favor. But what if that belief is the illusion? What if the system you trust with your paycheck, your retirement, your mortgage, and your future was never designed to lift everyone up, but instead to quietly extract value from the many and concentrate it in the hands of a few? Here's the paradox. The United States has the most sophisticated financial system in human history, yet millions of full-time workers live paycheck to paycheck. Productivity rises, technology advances, corporate profits soar, and still financial insecurity grows. This is not a story about a single villain. It's not about one bank, one crisis, or one corrupt decision. It's about a structure built over decades that functions exactly as designed. The question is not whether the system is failing ordinary people. The real mystery is why this outcome keeps repeating, no matter who is in power. And to understand that, we have to go back to the beginning. Money feels natural today. Digital balances, credit scores, interest rates, inflation reports. But none of this is natural. Every part of the financial system is a human invention, shaped by political choices, power struggles, and incentives. At its core, the modern U.S. financial system rests on three pillars. First, debt-based money. Nearly every dollar in circulation is created through borrowing. Second, central banking. An institution designed to stabilize the system, but insulated from democratic pressure. Third, financialization. An economy where profits increasingly come not from making things, but from moving money. These pillars didn't appear overnight. They evolved through wars, depressions, lobbying campaigns, and crises, each one expanding the system's complexity while quietly shifting risk downward. What makes this system so difficult to question is that it appears neutral. Interest rates sound technical, inflation sounds abstract, bailouts sound temporary. But behind these terms are real consequences. Who gains wealth, who absorbs losses, and who is protected when the system breaks. To see the pattern, we need to follow the story in order, from origin to outcome. In the early days of American history, money was simple and unstable. Banks failed often. Credit was scarce. Economic crashes were brutal and frequent. The turning point came in 1913 with the creation of the Federal Reserve System. Officially, the Federal Reserve was created to prevent financial panics and stabilize the economy. Unofficially, it centralized control over money creation, shifting power away from elected bodies and toward financial institutions. From that moment on, money in the U.S. was no longer primarily issued by the government. It was issued by banks as debt. Every time a bank makes a loan, new money is created. And every dollar created this way comes with interest, meaning more money must be extracted from the economy than was created in the first place. This design quietly embeds scarcity into abundance. No matter how productive society becomes, the system requires perpetual growth just to remain solvent. That's not a bug. That's the engine. After World War II, the system appeared to work beautifully. The US dollar became the world's reserve currency. American manufacturing boomed. Wages rose alongside productivity, but beneath the surface, a shift was already underway. In 1971, the United States severed the final link between the dollar and gold. From that point on, money was backed by confidence, not a physical constraint. This allowed unprecedented flexibility. It also removed discipline. Credit expanded rapidly. Households were encouraged to borrow for homes, cars, education, healthcare. Debt replaced wage growth as the primary way Americans maintained living standards. At the same time, Wall Street transformed. Finance stopped serving the economy, and the economy began serving finance. Complex instruments, derivatives, and leverage multiplied. Risk didn't disappear. It was even sliced, repackaged, and sold. And most importantly, the people designing the system were no longer exposed to its failures. The illusion collapsed in 2008. Years of reckless lending, opaque securities, and excessive leverage detonated into the largest financial crisis since the Great Depression. Banks failed. Markets froze. The global economy teetered. But here's the critical moment, the one that reveals how the system truly works. When the losses became unbearable, they were not absorbed by the architects of risk. They were transferred. Trillions of dollars were created to stabilize banks. Meanwhile, millions of Americans lost homes, jobs, and retirement savings. No major executives went to prison. No fundamental redesign occurred. The message was clear, even if unspoken. Losses are socialized. Gains are privatized. From that point forward, the system crossed a psychological line. It no longer even pretended to be symmetrical. After the crisis, interest rates were pushed near zero. This was supposed to help everyone, but cheap money doesn't flow evenly. It flows first to those closest to the financial system. Banks, corporations, asset holders. Stock markets surged. Real estate prices exploded. Wealth inequality widened dramatically. For ordinary Americans, the recovery felt different. Wages stagnated. Costs rose. Savings earned almost nothing. The system didn't collapse. It hardened. Those without assets fell further behind. Those with assets pulled away. And once again, the structure worked exactly as designed. Since 2008, policymakers have promised reform. New regulations, stress tests, oversight committees. But none of these address the core issue: a debt-based system that requires constant expansion, even when society no longer benefits from it. Instead of restructuring debt, the system doubled down. Instead of reducing leverage, it increased dependence on central bank intervention. By the time the next crisis arrived, whether from a pandemic, geopolitical shock, or market instability, the response was already scripted. Print more, borrow more, inflate more. Each fix postpones collapse by increasing fragility. Today, the symptoms are impossible to ignore. Household debt is at record levels. Housing affordability is near historic lows. Younger generations are wealthier on paper but poorer in reality. Inflation erodes purchasing power, silently transferring wealth from savers to debtors, from workers to asset holders. The same institutions that warned about excess risk now depend on permanent intervention. The same logic repeats. If markets fall, rescue them. If wages fall, explain them. History isn't repeating exactly, it's rhyming. The names change. The tools change. The outcome remains familiar. A system that claims neutrality but consistently protects capital over labor, stability over fairness, confidence over truth. This story isn't about hopelessness. It's about clarity. Here are 3 takeaways that matter. First, the financial system is not broken, it is structured. Understanding its design explains its outcomes. Second, debt is not just an economic tool. It is a mechanism of control. Those who issue it shape the future. Third, crises are not anomalies. They are pressure releases in a system that concentrates risk downward. The most dangerous myth is that this is inevitable, that nothing could be different, because systems created by people can be changed by people, but only once they are understood. So the question isn't whether the financial system will face another reckoning. The question is, when it happens again, will ordinary people still be the ones paying the price? If this documentary made you think differently about money, power, and history, support the channel by liking the video, subscribing for future deep dives, and sharing your thoughts in the comments. Because understanding the system is the first step toward no longer being trapped inside it.